SBFC Finance Q1 FY26 concall highlights financial performance profit after tax 101 crores, showing 28% year-on-year growth. Assets under management grew to 9,351 crores, up 30% year-over-year and 7% quarter-over-quarter. Yields improved to 17.99%. Cost of borrowing decreased to 9.32%. Spread stood at 8.67%. Return on average equity at 13.53%, and return on average assets at 4.5%. Capital adequacy remains strong at 34.3%, with a tangible net worth of 3,039 crores. Business and operational highlights. Added 10 new branches, taking the total to 215. OPEX to AUM reduced by 25 basis points year-over-year to 4.59%. Productivity per branch and per employee is consistently improving. 175 out of 215 branches now offer gold loans, often co-located with MSME lending. Disbursements were approximately 800 crores during the quarter. The company disburses about 2,700 to 2,800 MSME loans monthly, and this pace is expected to continue. Asset quality and risk management stress is visible in loans below 10 lakh rupees. Credit cost at 1.11%, expected to rise by 15 to 20 basis points. Gross NPA stable at 2.78%. Provision coverage ratio at 44.4%, expected to remain in the 44 to 45% range. Credit filters tightened in February. Rejection rates up by 10%. A political ordinance in Karnataka negatively impacted collections. MSME book is largely service-oriented, mainly mom-and-pop stores, making cluster analysis more relevant. Hand loans remain a gray area, assessed through personal discussions with borrowers. 0 to 30 DPD curing rate remains stable year-on-year. Macroeconomic commentary: semi-urban and rural regions are performing better than metros. Urban areas facing income stagnation, weak consumption, and low job creation. Organized retail and e-commerce are impacting small neighborhood stores. Liquidity is ample, but borrower demand remains muted. MSME stress also linked to tightening in unsecured lending and reduced money velocity. Guidance and future outlook targeting 5 to 7% quarter-over-quarter AUM growth. Profitability expected to be maintained, despite higher credit costs. On track to achieve 15% return on equity, up from 13.5% now. Borrowing costs expected to trend lower gradually. Co-origination AUM was seasonally weaker in Q1, but is expected to pick up. Return on assets stable at 4.5 to 4.6%, may compress to 4.2 to 4.25% as leverage increases, supporting the 15% ROE goal. Long-term focus remains on strengthening the balance sheet and building provisions.